Welcome, everyone, to the new podcast, or new episode, I should say, of The Professor and I. And today's professor is Mr. Adam Cube. So, Adam, basically, whoever's the guest of the day is the professor for that day.
Okay.
And you happen to be the professor
For today.
for today's show.
Okay.
Adam works with me at People's Discount Mortgage. And he is the reason we have him as a guest. One of the reasons, I should say, is his knowledge on the secondary and overall mortgage industry as far as the guidelines are concerned, and underwriting guidelines, secondary. He does a little bit of everything. So welcome to the show. Adam,
you.
why don't you tell us about yourself a little bit? And, I know you have a lot of roles
Yeah.
that you do for the company, but mainly like a brief,
Brief.
and then how long you've been in the business and stuff like that.
All right. Name's Adam Cube. I've been doing mortgage since 2000, and started as a loan officer. But after 1 year, I had a niche figuring out how to do guidelines. Ended up fixing other people's loans.
Which is important.
Yes.
Yeah, the name of the game.
Yeah, and to this day, I still fix everyone's loans.
That he does.
I am the cleaner. I basically clean up all the mess.
Yes.
And funnel them up so I can go ahead and sell the loans off to the secondary market.
Right.
So
And that's a special, talent, Adam, because we can fund any loan.
yeah,
It's getting it sold.
Yes.
Is where the real trick is, right?
right.
Yeah.
And,
So
and finding the holes and just being able to figure that stuff out real quick.
right.
I would say my best feature is problem solving.
Problem solving, and
Yes.
which is a very important feature for people that are in the banking industry. They know that if you don't have a good problem solver and you have files that cannot be sold, you're in trouble,
Yeah.
right? And then it gets expensive really, really fast.
I say I'm like insurance.
Exactly.
Right.
He makes sure that we don't lose money and we get the files purchased.
I cost a little bit of money, but I can save you a whole lot more.
Which is very important.
Which is insurance.
And then get them sold in time.
Yes.
Right.
Yes.
So Adam also does our secondary. He also does at the moment. He locks loans for us, and I wanted to have Adam on as a guest today to kind of explain to us the new LLPAs, which stands for loan level price adjustments that the U.S. Well, I don't know if I'll let you explain more, but Fannie and Freddie put in place starting May 1st, right? Adam, correct me if I'm
Well,
wrong.
they've been around. But
been around.
They've changed them starting May 1st.
May 1st, it took effect,
Yeah.
right?
Yeah.
And in our business, a lot of guidelines do make sense. A lot of guidelines don't make sense.
Right.
Or rulings, right? And I think this falls into the no sense guideline, in my opinion, but I will let you explain, and then I'll let people decide for themselves if it makes sense to them or not. But to me, it's to a normal person, a normal home buyer, when they watch the news, and a lot of times the news does not explain what the ruling is properly, right? So that's where we're here to see if we can do our best to explain to the consumer
Yeah.
how it's going to affect people with good credit and how it's going to affect people with not so good credit,
Right.
right? So from my understanding, Adam, is that this new loan, the LLPA, loan level pricing adjustment, that was announced or took effect May 1st, it's going to punish, in a sense, people that pay their bills on time, that they have good credit, correct? And it's going to help people that don't pay their bills on time and have poor credit or not as good credit. And when I say good credit, would you say 740 or 760 and above?
Yeah. 740.
740 and above is considered good credit, and anything below that is
Yeah. 740 to 680.
680.
Mediocre. And
But this is really going to benefit financially the clients that are subpar, below 640, or I would say between 640 and 680,
yeah.
and maybe even lower.
Yeah.
So I will let Adam explain how, and it is more expensive as far as fees are concerned,
Yes.
right? But not technically interest rate. But Adam, go ahead and kind of give us your opinion of what the rule is and how it's going to affect people with good credit and how it's going to benefit people with bad credit.
Right.
So let's call it a no nonsense rule or no make sense rule. But let's let you explain it.
So I'll try to explain it. Loan level pricing doesn't really, consumers don't really see that.
Right.
What they are is they're based on the risk. It's an assessed risk between what's involved is your FICO score,
Right.
your loan to value, or how much down payment you're putting in, what type of loan it is, type of property it is. So it affects that. So the way for me to explain to people that don't understand is Fannie and Freddie is owned by the government. They're GSEs.
Correct.
And what
And
banks,
explain what GSEs are, Adam. Somebody's watching this who's not a
government.
sponsored entities, right?
Yes.
Okay, thank you.
Enterprise.
Yeah,
Yes.
enterprise, yeah.
So banks, Wells Fargo,
Right.
Bank of America, the big banks, or us bankers here, we sell loans to Fannie and Freddie.
Correct.
And what they do is they give you a price for the interest rate you're delivering.
Or premium, same
A
thing.
premium,
Yeah, okay.
right?
Yeah.
So, for example, a 6.5% rate.
Right.
Fannie Mae is going to pay us, that's a premium of 3%.
When we
So-
sell the loan.
When you sell the loan.
Correct.
But you need to incorporate the loan level pricing. So it's a grid. So you look at your client, 740 with a 80% loan to value.
Right.
When you go to a grid, it's going to show you negative 50 basis points.
Right.
So instead of that loan being sold, instead of me selling that loan for 3%, that loan level pricing hit, it now is being sold at 2.5%.
2.5, right.
So what lenders end up doing is after you do all the different adjustments from the loan level pricing, they typically will either increase the interest rate they're offering to make the premium that the premium they need.
Correct.
So that's kind of what loan level pricing is. So it's determined by, like I said, mainly FICO score and loan to value.
And is that only on conventional loans, or is it across the board?
Only conventional loans.
So yeah, because that's good to know. So it's government loans, which is your normal first-time home buyer programs, FHA, or if you're a veteran or VA loan,
USDA,
is
yeah.
not affected by this ruling.
nope.
It's mainly people who are doing conforming loans or conventional loans.
Yeah.
Okay.
Fannie and Freddie.
Fannie and
basically.
Freddie products.
Yeah.
Okay.
So the way the news made it sound like they are punishing, not punishing, they are giving a larger hit to people with a 640 FICO.
And when you say
740.
hit, Adam, is that in not in the rate, right? It's mainly they're going to pay higher fees,
The lender is paying higher fees.
which in turn we're going to pass it on to the consumer.
Correct.
Right?
Correct.
Okay, so
Yeah.
basically, so the consumer, let's say if you are, let's use an example, 740 FICO, and let's say a month ago, you were going to get the interest rate of 6.5, right? To give, for example, you would have, let's say, not paid anything in fees. I'm just using that as an example.
Yeah.
Technically.
Let's say, so in the big scope of things is, let's say for example, I would give that 6.5%. Well,
Right.
now I'd be getting a 6.75 probably.
Right. Or if I get a 6.5, I'm going to have to pay some fees.
Right.
Which before May 1st, it was not there.
Right.
Now let's do the other side. If you are a 640 FICO score, how do you benefit from that?
So if you're a 640 FICO score, the cost previously was so much that
So
you
much,
may
yeah.
not even be able to get an interest rate.
Correct.
So
On a conventional loan.
on a conventional
Correct,
loan.
correct.
So what my belief is, yes, you're basically robbing Peter to pay
Right,
Paul.
right.
But now you've opened up a pool
Right.
of the lower FICO score people to be able to get into a home.
Correct.
So that's the good part of what's happening.
Correct. So there,
Right.
there is, of course, there's a
There's-
good side to everything, right? So yeah.
Yeah.
So,
the
in
whole
that
thing
sense,
is make the home affordable, right?
or even doable
Yeah, or doable.
for people who want to do a conventional loan with 640 FICO.
Yeah.
Like you said, the pricing level adjustments were so much that sometimes we couldn't even do it.
It was to the point of, I'll give you an example, a 640. Actually, let me look at the grid. I don't memorize the
Yeah, yeah.
grids. Let's see. This was.
And then hopefully we can share that on the link so that way people can understand what we look at as bankers as far as what the guidelines are. Or you guys can just Google
Yeah.
Fannie Mae or Freddie Mac LLPAs, right? And that'll tell you. It's really easy to look at. But if you have questions reading it, if you do look it up, we'll have a link below where to contact us, and then you guys can call, and we'd be happy to answer any questions.
Absolutely.
Yeah.
Absolutely.
And this is actually awesome for the realtor professionals
Yes.
to understand, because they're the ones that refer clients to us in most cases, right? So the clients are probably going to be asking them the questions as well. Hey, what is this, right? So it'd be good for them to make themselves more knowledgeable.
Yeah,
Or
absolutely.
educate themselves. And Adam, really, it's coming down to basically more education to the consumer, to the realtor professionals, and anybody that's looking to buy or sell. basically our job is to educate.
Yeah,
right?
and I see a lot of people go backwards and go look
Correct.
for a house first before talking to a professional.
Correct.
And you waste a lot of time, effort,
Yeah.
and
Yeah.
people get frustrated when they don't technically qualify.
Right. And a lot of people just worry about what the interest rates are, right?
Yeah.
Well, but there's a lot of other factors that are involved in buying a home.
Yes.
Right? So go ahead. So give us an example of what the cost would have been for a low FICO score person before the change and what it is now. So what benefits they're going to be having.
So, for example, someone that was a 640 to 659 FICO score, right? And they were only putting down 10%,
Okay?
right? Previously, their loan level adjustment would be 3.25%.
And that's a fee
That's a fee.
off the loan amount.
Off the loan amount.
Okay.
That's the fee.
The
The adjustment.
And Adam,
the
real
premium.
quick, we are going to get a whiteboard. I ordered it, but it didn't show up on time. So I think it'd be great in the next episode that we can actually, have it behind us or behind whatever, and then we can actually, do a little like a classroom
Classroom.
style, so where people can understand it.
I might not be the best teacher for that.
Well,
but it's okay.
It's all right.
So going back to 640, 659.
Yeah.
The hit for that for someone that puts 10% down.
Yeah.
Which is quite a bit. For
Well, an average sales price of let's say 500,000. That's 50 grand.
that's 50 grand.
Right.
Yeah.
Okay.
So that cost would be what did I tell you?
3.25.
3.25%.
Right. So that's a loan amount of 400,000. Sorry, 450. So that's $14,000 in fees, depending on what rate we gave to the client.
Yeah.
Right. Okay.
So now we're looking at 640.
Yeah.
And that hit is now going to only be 2%.
So that's 1.25
Difference.
So that's about almost 7 grand.
Yeah.
So
But the main thing is at that pricing of 3.25 adjustment,
yeah,
banks aren't paying enough to get that interest rate.
correct.
And we have what they call, TRID high costs or California high costs,
Correct.
right? And then you get stuck with 3%. So even
Correct.
if you have the money and you want to get a
We
house,
couldn't do it
We couldn't do it.
with the low FICO scores.
Right.
So now this brings those buyers into that equation.
Correct.
To be able to at least get a loan before they might not be able to get a loan. Now, they might have been able to qualify for an FHA or a VA.
Yeah.
But a lot of times the clients cannot go FHA or VA. They have to go conventional. One, either they're married and the spouse have a high debt.
Yeah.
Right? That's usually the case. And on conventional, we don't have to include the spouse's debt.
Correct.
So there's other reasons as well, but that's the main one that why we go conventional. Why not just do an FHA on them?
Right.
Right?
Right.
Or for example, let's say, well, that won't really qualify for people that own a home currently. What about the example of, let's say, 740 before and after May 1st? So
Okay.
how much higher is a buyer going to pay now?
For someone that had a 740 FICO score with
Yeah.
10% down,
Yeah.
it was going to be a quarter cost,
Okay.
a quarter adjustment.
Okay.
Okay.
Yeah.
Now 740 at 10% down
Yeah.
is now 0.75,
So it's a 0.5% more.
0.5% cost.
Okay.
Yeah.
So once again, if you look at the dollar amount, right? So on a $100,000 loan amount, that's $500.
Yeah.
More they were going to pay. So on 400, they're going to pay $2 grand.
Yeah.
But if you take that over, if they keep the loan for 30 years, well, that's
Yeah.
it is a big number.
Yeah, it is a number.
And then
chances of them keeping that loan though is
Yeah.
slim to none.
I think average in the nation that especially it's going to change a lot because
Yeah.
the rates are high and people
Yeah.
are going to who are in 6 and above interest rate category. I believe they're going to be refinancing. So yeah, maybe a year or two we'll see that change.
Yeah.
Maybe a little longer, but it's going to happen. The
Yes.
rates will come down. But average person in USA keeps a mortgage for about 7 years, I think.
Yeah,
They either sell or move or refi or something,
I
right?
would say 5.
5 years?
I would
Okay.
say 5.
5 years. So that's
Yeah.
that's probably we'll look it up
Yeah.
to be clear, but that's to do an average. So that tells you that the rates, these pricing, yeah. If you do the averages over 30 years, it doesn't it's a lot of money, but it doesn't really matter.
Yeah.
If it's 5 years, okay, but still it's 10 grand in 5 years.
Yeah.
That the person with good credit is going to pay versus a person with poor credit.
Right,
Right.
right.
So, in your opinion, Adam, I know to me, or to a lot of people, if you look at it from just the change aspect of it, it doesn't make sense.
No, it
doesn't.
doesn't make sense. But someone has to take that risk on.
Correct.
Right? So it is going to be the higher FICO score people
Right.
that are taking that.
So should we thank the people with high credit who pay their bills on time, or should the people with poor credit should thank them? Right? In a sense, that's what it comes down to.
Right.
Yeah.
Yeah.
Yeah. So if you do have average credit and you know somebody who has good credit, you should walk up to them and thank them, because now they're going to be paying for your benefit in a sense.
Yeah. I mean, the news just, in my opinion, like just blew it out of proportion. I mean, it is a difference, but it's not as bad as what they made it to be.
Right.
I mean, and it's been in effect since March, like late March.
Right, but the guidelines when they came out, when the change was announced or signed or
was
approved,
almost immediately done in March.
so most lenders had already adjusted for it, or most bank that we sell to had already kind of adjusted for it.
So the May 1st is technically the rule is that if the loan was sold to Fannie Freddie, after that the adjustments come into play.
Got it.
But loans are being serviced
Right.
with those adjustments already been in place.
In place already.
Right.
Okay.
So that's why as soon as it came out, it's already, the interest rates currently right now, before May 1, it already incorporated the changes.
Right. And like you said, I don't watch much news, but once in a while I do watch some. And everybody had a different opinion, but nobody really gave you the facts or explained it.
Yeah.
Right. It was all about scaring people and actually making people. The way I took it was that it was insulting to people with good credit, the way they made it sound like, right?
Yeah.
Well, in a sense, it is.
It is.
Because you are punishing people for, in a sense, who pay their bills on time.
Yes.
They take pride in their credit scores, and then the people who don't pay their bills on time are getting a benefit of
discount.
So they're getting rewarded for bad behavior. It's like a parent rewarding a child for doing something wrong,
right?
Instead of punishing them, but hey, things have changed, right?
Right. Yeah.
As far as that's concerned, so
I mean, really trying to understanding the LLPAs. I've been trying to figure out how to explain that to a consumer, a normal person. Right?
Yeah.
And I came up with. I mean, I saw an article and I thought it kind of made sense to me. Like if you're buying a car, think of it as someone buying a car. Right. You're buying a base car, that's all it is. But every time you add something to it, it's going to cost more. So same idea.
Good analogy. Yeah.
It's the same idea. It's like you buy a base car for $30,000. You want heated seats, okay, it's going to be $31,000.
Right.
If you want navigation, it's $32,000. Every little feature is going to have an adjustment, right? So same thing with homes. If you're at 60%, if you're putting 40% down with a 780 FICO score, that's your base price.
Right.
Your base right there.
Yeah.
All right, you're now 700. Okay, it's going to cost you more. Oh, you want to put 20% less?
Right.
It's going to cost you more. So that's kind of what loan level hits are.
Right. And those really apply on conventional loans, right?
Only.
So because for most government products, which is your VA and FHA and USDA, the rural product, their adjustments are not as drastic.
No.
For conventional loan, every 20 point in credit score has a different level adjustment.
Well, most investors have implemented loan level hits on their own.
Okay. On top of Fannie and Freddie's?
No, for FHA.
For FHA.
And VA,
correct.
Government loans.
Government loans, yeah.
For anything usually typically under 620.
Right.
Right.
A lot of banks don't even do it under 620.
Correct.
By the way, we do under 620. We go as low as 580, I believe.
Yeah.
On FHA loans.
Even lower than that.
Even lower than that. So if you are that category and a home buyer, and we can help because a lot of banks out there will not do below 620.
Yeah. And that's another reason why you do government loans is that Fannie and Freddie Mac stop you at 620.
Correct. And 620 is no exceptions for Fannie and Freddie.
No.
Because 619 you can do a conventional loan. Yeah. There's no exceptions. Correct.
Yeah. So that's where they come into play. Right. But in all reality, I think even at this market, anything below 660 is going to be tough for conventional loans, even with adjustments.
Even with the improved pricing,
yes,
it's still going to be difficult, right? And that's why a lot of times we have to convert those clients into a government loan if they qualify based on income and credit.
Yeah, right.
Because it is more lenient.
Yes,
as far as credit is concerned.
For FHA loans and VA loans.
FHA loan, yeah, and People's Discount Mortgage, which we both work for, and DBA PacWest Home Loans. You want to tell us about our operation, like as far as how many states we're in. I believe we're in 8 states at the moment, and then like we're considered a mortgage banker,
Yes.
right? So can you explain a little bit to people listening to us of what is a mortgage banker versus a mortgage broker?
Well, mortgage banker, basically we are lending our money that we lend our own money and we underwrite files.
Right.
The biggest feature is that we make the decisions for the most part.
Correct.
We don't put an outstanding extra rule.
Right.
As long as my investor that I'm going to sell the loan to is allowing that, then that's what we can do.
Right. So we fund with our own money. We have in-house underwriters.
Yes.
We process. We draw docs. We ship. Right. All A to Z.
A to Z.
So that's like a typical mortgage correspondent banker would be.
What most loan officers like being with the banker like ourselves is that I'm right upstairs.
Right. For our company, we have a lot of support. Yes.
Like if you have a question,
Right.
they go straight to me or to an underwriter. Right. No problem. Yeah. You go with a broker style. You have to go through a couple channels to maybe get to the person that makes the decision.
Right.
Over here, we're able to make that decision right away, or at least I would have to analyze the situation.
Right. And then a broker channel, of course, you're dealing with a third party basically who's funding your loan, right? A broker takes your application and then they have to submit it to their investor to see if they're going to do it.
Yeah.
Very similar process, but with us, the difference is that we make the decisions.
Yes.
Right. So you don't have to, and plus our job is to know guidelines.
Yeah.
We know right away if you're going to qualify or not. In most cases, right? And if a client does not, we never say no. If it's doable, we'll give them options.
Yeah.
Hey, you don't qualify at this moment.
You never say no.
Why never say no? Yeah.
I am known
Adam
to say.
is called Mr. No at the office.
Yes.
So if you want to hear a no, go to Adam. You want to fund the loan? Yeah, we'll make it work. But having said that, we give them options. We got a cosigner.
Absolutely, I can figure out.
Go pay off the car or pay off some credit card debt, right? Or go borrow some more money.
Yeah.
So that's what I was talking about as far as giving them options.
We'll help overcome the hurdles, basically. If there's a situation in their file that does not look correct, we give them the options of what other items we can provide, or you can provide us, or either, like you said, co-borrowers or other things.
More down payment, whatever there might be. Also, it's very important for us is that we deal with a lot of home buyers that are buying for the first time.
Yeah.
So we take our time, to educate. At least I do.
Yeah.
With my clients, and it has gotten a little bit more challenging. I should say, not just challenging, but more educational for me as well, because I have to educate my clients a little bit more on the process of home buying and how much buying power they should have, what they're paying in rent now. So other than that, are we out of time, guys? I don't know. The clock wasn't started, so.
No, you still got like 7-8 more minutes.
Okay, so we don't really have. They'll cut that out too if they need to.
Oh, which one? Oh.
No, so they added it, right?
Oh, got you.
So what else you want to discuss? Anything else you want to share?
I don't know. I can in my opinion, I always talk about me being able to qualify somebody within 5 minutes.
And Adam still does it old school with a calculator and a pen and paper.
Pen and paper.
Yeah, so that's and we have a few people like that have been in business for a long time.
Yeah, I mean, at a bar, I could qualify somebody real quick.
Yeah, we used to take applications on the napkin. I remember back in the day before the technology or that's what it was. You write a number on the napkin and you send it over to your processor or whatever. And hey, can you take a loan app on these people? So,
well, I mean, like kind of my story with applications, I just tell people they always ask me what I qualify for.
Right.
I go opposite. I go, what do you think you qualify? What can you afford?
What can you afford? Correct.
Right, and I'm not a big proponent of down payment assistance people. Just because if they can't,
we offer them.
Yeah, we offer them.
But like you said, if you can't bring in 3.5%,
if you can't save 3.5%,
then
my advice for first-time home buyers is figure out what you think you can pay.
Yeah.
And for 3 months, if you can make that payment,
right,
off to the savings.
Yeah. Challenge yourself, right?
Challenge yourself. Yeah. See if you can make that payment. If you can make that payment, then you are ready to buy a house.
Ready to buy a house. That's right.
That's my.
That's right. And then, Adam, for most first-time home buyers, can you just really quick tell us what's included in their payment? Let's say I'm going to give you an example. They're putting 5% down, right? So what's included in their payment, because it's different things that a lot of people think, oh, just the house payment.
Yeah,
That's
no,
not the case.
no.
So tell us what's included in their mortgage payment.
The loan itself is going to include principal and interest payment.
Correct.
That's just for the loan.
Right.
Then you have hazard insurance.
Right. Or fire insurance.
Fire insurance.
Right.
Okay.
Yeah.
Unless you're in a condominium, right? Then you would, the condominium would typically handle the fire insurance, but you would have to get a separate insurance.
The
inside.
walls in.
Walls in.
Right.
It's called an HO6.
For your personal property.
Personal property. That's only for condos.
For condos or townhomes.
Or townhomes.
Okay.
And then other than that is property tax.
Right.
Everyone's going to have property tax. You're never going to go away from property tax.
Correct. And property taxes differ from each county.
Yeah.
But local counties to us, which is San Bernardino, Riverside, Orange, LA, and San Diego, normal tax rate that we use is 1.25%.
It's 1.25
off a sales price.
Yeah, if you're in a newer area,
Yeah.
it's going to be more than that.
It's going to be more than that, but
If you
for
have-
average.
Yeah, for an average. But if you are in an area with a park, a brand new fire department, or
Right.
nicer lights,
It's going to be so. It's important to ask your realtor
Yeah.
before you make the offer. Say, hey, what is the tax rate?
Yeah.
Is there any special assessments? Right? Is there any HOA?
Yeah.
And then also and mortgage insurance, right? If you're putting less than 20% down.
if you're putting this 20% down, you will have mortgage insurance.
Right.
And that'll vary on your loan level hits, basically.
Correct.
It's gonna, if you have a lower FICO score, it's going to be more expensive.
More expensive.
So the higher risk you are, the more expensive it gets.
And then on those people that have to have mortgage insurance, which is required, if you have excellent scores, there's an option to purchase it out.
Yes.
Right? But if you are required, either way, we have to approve the loan first, and then it has to go to a secondary approval for the mortgage insurance company as well.
We
them to issue
we choose that.
We choose that, okay.
Yeah, we choose that. But
Okay.
technically, I can just approve it on our own.
Okay.
But I like that extra layer of defense.
Okay.
To protect
So the four things that this is for the first-time home buyers, right? So you got to consider in your mortgage payment, you have your principal interest, you have your property taxes, you have your hazard insurance, and then you have your mortgage insurance. And then if you bought a condo or a townhome, you're going to have HOAs, right, Adam?
Nope.
Yeah. And then other than that, that's very important for people who are buying for the first time to understand that your payment is based on all those factors, not just your principal interest.
Yes.
Right? And if you're putting less than 10% down, you have to pay that together.
You have to be
Or is it,
compounded.
right? Is it
Yes.
10% or
10% California? Yes.
and 10% or more, they have an option of paying their mortgage payment separately.
Yes.
And their insurance and taxes
Only
separately.
on conventional loans.
Only on conventional loans, correct. This is, yeah. But
conventional loans.
FHA and VA, regardless, it's always included in your part of your
And
payment.
and for conventional loans, if you have mortgage insurance, you're required to keep it for 2 years, no matter how much equity you have.
Okay.
Like if you gain
If your
so
property
much-
gained equity.
Yes.
Okay. Unless you refinance.
unless you refinance.
Okay.
But a lot of people out there are saying, "Oh, put less money down
Right.
because your hits are less, your loan level hits are less."
Right.
But then you're paying mortgage insurance, so
So it's important for the client, to whoever's looking to buy, to talk to whoever they're going to use,
Yeah.
to ask the right questions.
Yes.
Right. So it really comes down to service and who they're working with.
and who you're going to deal with.
Who are you going to deal with?
Yeah, because your loan officer may not be super educated about everything.
Correct.
And he's just a really good speaker.
Yeah. Yeah.
Right.
That's the case the majority of the time. Yeah. Yeah. They just want that sale.
Yeah.
Yeah.
Exactly.
Yeah. So okay. Well, Adam, I this was awesome information that you shared with us, and hopefully we could put the links in the website and then put your contact information as well. Whenever this podcast gets out there,
Yeah.
We're still working on that. But if people have questions, they can always reach out to you, and we'll put your contact information
Sounds good. Yeah.
on there. And hope you had fun. I don't know, is this your first time doing a podcast?
First time.
All right. So tell me, how did it feel? Or you,
It feels okay. I mean,
it feels
depends. It depends on your questions. And
Yeah.
As your questions come in,
Yeah.
they're very easy to come up with. My own situation, my own.
your own show?
Yeah. You can't just talk. You need the.
And you're right. I think when I keep bringing James up, but he taught me a lot, because that was my second podcast that I recorded, and I learned a lot because he just it was just like having a conversation.
Yeah.
Yeah, it just felt very natural. And of course, this is something totally new to me. And
Yeah.
I'm not a big
Yeah.
person in social media, but this is something that my staff is making me do this to get better at it. So, I have to kind of.
No, I mean,
So
you know a
I'm
lot
trying.
of people, and you're great at the, That's
Yeah,
why you're.
we're offering this room to. By the way, if the people that are watching this, if you do want to take advantage of your own podcast, we're here to help. We can offer this room to you. We have a beautiful crew that can help you edit and record videos for you, and take your business to the next level. So reach out to us, and we'll put that how to contact and who to contact in the link below as well. So by that, Adam, thank you for coming today. And every show that I do it becomes easier and more fun to me. What a difference with the
Oh
headsets.
man, yeah.